If you've been trading crypto lately, you're likely feeling the bleed. You buy what looks like a confirmed breakout, only to watch the market immediately reverse and wipe out your position. The current push toward $80,000 functions as an exit liquidity engine for institutional desks. They require retail buying volume to fill the other side of their large sell orders. To see this in the data, we have to look at the on-chain liquidity clusters, hidden macro catalysts, and the daily chart divergences that point toward a significant rejection. Welcome to Crypto Whale Radar. Mastering these specific signals is how you stop losing capital to market makers and start extracting profit from their manipulation. Notice how price swept through this dense short seller liquidity cluster at $80,000. Now, a new liquidity pocket has formed above us, between $80,800 and $81,100. The market is magnetically pulled upward to clear this pocket. While the price climbs toward that $81,000 magnet, a time-based Fibonacci sequence on the 3-day chart is flashing a warning sign. This indicator projects the date the structural symmetry of this move breaks down, which I will reveal in just a few minutes. Buying spot Bitcoin at these levels provides the liquidity institutions need to close their existing long positions. Bitcoin's daily price makes higher highs on top, while the RSI and MACD indicators make lower highs on the bottom. The trend's energy is fading. Morphing this chart to the S&P 500 index reveals the exact same bearish divergence, validating this weakness. Let's map out the structural correction. Bitcoin is completing the final Y wave of a WXY corrective pattern, aligning with a 1-to-1 Fibonacci extension resting exactly at $81,000. Toggling to a logarithmic scale shifts that exact same extension higher, hitting resistance at $82,500. Even if the market prints one final wick to grab that higher liquidity, the underlying momentum is completely exhausted. This chart tracks Bitcoin dominance, which is now breaking and holding above a historic horizontal resistance zone at 61%. Because Bitcoin is absorbing the available capital, major altcoins are bleeding out against it. Assets like Ethereum and Solana remain stalled under heavy multi-month resistance levels. The current bullish structure of Bitcoin dominance suggests that altcoins will continue to underperform in the immediate term. When this wedge breaks down, we can use the anchored volume-weighted average price, or VWAP, to identify targets at $79,300, followed by $78,300. Zooming out, if those initial macro supports fail to hold, the final anchored VWAP floor rests at $73,800. With Bitcoin facing this much severe downside exposure, rotating your capital into altcoin breakouts carries a high mathematical risk. The downside across the broader pit is the primary factor to watch. These technicals are currently colliding with a difficult macroeconomic environment. In the U.S. Senate, the Clarity Act, legislation vital to institutional crypto market structure, has stalled in committee and is unlikely to pass this year. Simultaneously, the tech sector is navigating a white-collar recession. Over 81,000 recent layoffs have drained retail liquidity from a demographic that typically supports digital asset prices. Looking at institutional behavior, Warren Buffett's Berkshire Hathaway is sitting on its largest cash pile in history. This signals a lack of viable risk-adjusted opportunities across the entire market. Furthermore, geopolitical tensions in the Middle East are causing oil prices to rise. This drives U.S. government bond yields toward 4.45%, encouraging the Federal Reserve to maintain restrictive monetary policy. This brings us back to the time-based Fibonacci sequence. The indicator projects that structural symmetry is topping out now, aligning perfectly with these macro headwinds. The crypto market is hitting an impenetrable wall of macroeconomic exhaustion. In this environment, simply holding spot assets and waiting for a recovery can lead to significant capital erosion. Active hedging is necessary. There is a structural edge in shorting these resistance levels. I execute these market-neutral setups exclusively on BingX. BingX provides the execution speed and depth required for high-level hedging and risk management during periods of high volatility. Using the referral link in the description unlocks exchange bonuses and provides direct access to my live trading setups. However, this technical rejection is unlikely to result in a permanent collapse. Visa is actively rolling out massive stablecoin settlement integrations across networks like Polygon, Solana, and Avalanche. Simultaneously, Morgan Stanley has launched dedicated funds to back stablecoins with U.S. Treasury bills on-chain. Shorting this resistance provides a tactical hedge against the structural reset we're seeing in the data. The long-term floor established by institutional players remains firmly in place. Here is the tactical directive. Avoid longing the $81,000 liquidity sweep. Wait for the daily bearish divergence to fully confirm in the momentum indicators before layering into short positions. Prepare your portfolio for targeted hedges at the VWAP support levels we identified. Navigating a crab market requires daily, objective analysis. Subscribe to Crypto Whale Radar and turn on notifications to protect your capital. Knowing when to execute a short is only half the battle. Success comes from setting exact invalidation levels to avoid liquidation by random price wicks. Click the video on your screen now to learn the risk management and stop-loss strategy required for high-leverage hedging. Survival as a trader depends entirely on emotionless execution and rigid invalidation metrics. I'll see you in the next video.